They actually did it. Those 4 words tore through social media just moments after the Iranian parliament officially approved the closure of the Strait of Hormuz. Global watchers were stunned, analysts were rattled, and market players scrambled to adjust their positions. Why on earth would Iran make such a drastic move, especially now? And even more importantly, what would it mean for global oil supply, inflation, and that once sky-high digital asset we all know as Bitcoin? Today, we are diving headfirst into this swirling cauldron of geopolitics, economic shockwaves, and crypto market turmoil. We will uncover why the closure of a narrow maritime passage has just become the world's most explosive headline, how it could tip economies off balance, and why Bitcoin just might never be the same. First, let us establish the stage. We have Iran's parliament declaring its intent to shut down one of the planet's most heavily trafficked maritime routes, the Strait of Hormuz. At the same time, we have the United States launching coordinated strikes on Iranian nuclear targets. These strikes mark the first overt intervention by Washington in the intensifying Iran-Israel conflict. Add to that President Donald Trump's bold pronouncement on Truth Social, calling the operation very successful, and you get a sense of the escalating drama that is sending global media outlets into a frenzy. With both sides apparently doubling down, the question arises, how did we reach this bewildering standoff? And why does it matter to everyday folks on the other side of the planet who might just be filling up their cars, paying their utility bills, and maybe, just maybe, buying a fraction of Bitcoin? To answer that, we need to understand the Strait of Hormuz itself. This channel is not just any maritime route. It is the unspoken lifeblood for about 20 million barrels of crude oil every day. That is roughly 20% of the world's daily consumption and roughly 1/3 of all seaborne oil trade. Oddly enough, it is a relatively narrow choke point, linking the Persian Gulf with the Gulf of Oman and the Arabian Sea. It handles mammoth tanker ships that feed China, India, Japan, and South Korea, some of the world's most voracious oil importers. Experts warn that if Iran truly makes good on its plan, shutting this strait means the global oil faucet gets squeezed, hard. Let us paint a vivid picture. Imagine thousands upon thousands of barrels of crude that were happily cruising along to their destinations. Suddenly, the ships are halted or forced to reroute via far longer and less efficient maritime paths. This does not simply inconvenience shipping companies. When oil supply is throttled, the entire global economy reacts, often violently. Prices at the pump go up, and so do transportation costs for goods, fueling an inflationary ripple effect that can crank up grocery bills, utility costs, and manufacturing expenses worldwide. By extension, household budgets feel the squeeze, businesses tighten their belts, and central banks are left with the dilemma: raise interest rates to combat inflation or loosen the monetary reins to avert recession. Here is where things get surreal for cryptocurrency enthusiasts. Bitcoin, that digital darling, was riding a wave of optimism, hitting around $103,000 not so long ago. Then, in a move that stung bulls across the globe, Bitcoin tumbled to about $99,700 after news of Iran's parliamentary approval broke. The financial community is left scratching its head. Exactly how does a closure in the Middle East cause the world's leading digital asset to lose ground? After all, Bitcoin has often been hailed as a hedge against geopolitical instability, some sort of digital gold. But the reality is more complicated. Our modern markets are deeply interconnected beasts. A threat to oil shipping can spawn panic about inflation, fears about economic slowdown, and anxiety that can spook investors out of riskier alternatives like Bitcoin. What is even more intriguing is that the current measure is not yet final in Iran. The closure of the strait still needs green lights from the Supreme National Security Council and, ultimately, Supreme Leader Ayatollah Ali Khamenei. Nonetheless, the parliamentary approval alone telegraphed to the world that Tehran is not bluffing this time. The question remains, is Tehran's calculation more of a strategic maneuver, an attempt to fast-track negotiations, or an outright severance of economic ties in the region? The answer may lie in the broader context. These events coincide with the United States launching strikes on Iranian nuclear facilities, an undeniably provocative move, and with allegations that Iran has become a pivotal player in a broader Middle Eastern conflict. To many analysts, shutting the Strait of Hormuz is a bold statement that says, push us too far, and we can hamper the flow of the world's most critical commodity. It is no secret that major economies rely heavily on this flow. China, in particular, sources nearly half of its crude imports via this route. Quartets of supertankers regularly chug along its waters, bridging the gap between Persian Gulf oil fields and massive refineries in Eastern Asia. That is why, if the closure actually happens and persists, oil could climb well above $100 per barrel, possibly spiking to $120 or even $150. Some are even floating the doomsday scenario of indefinite closure, which would almost certainly cause a global shortage, leading to severe recessions in nations that lack the capacity to replace those vital barrels elsewhere. Meanwhile, the threat of inflation is very real. When energy prices shoot upward, so do the costs for nearly everything else, from airline tickets and holiday packages to food on your table. Because so much of our modern world depends on petroleum, over 90% of global goods rely on it for production or transportation, the shock could be jarring. Economists warn that a prolonged closure could subtract 1 or 2% from the global gross domestic product if the higher costs of energy endure. This hamper on growth would happen exactly when the world is already juggling economic uncertainty in the wake of shifting trade alliances, post-pandemic developments, and looming currency debates. And let us not underestimate the psychological aspect. Bitcoin's price slump, though fleeting in the grand scheme, functioned as a jolt to the crypto faithful. Many had pinned hopes on Bitcoin as the new safe harbor asset, immune to earthly geopolitics. Yet, as we have seen, markets do not always behave in ways that match tidy theories. Yes, Bitcoin could theoretically be an inflation shield. Still, panic can cause people to liquidate what they view as speculative assets first, rather than hang on for dear life. By the way, if you appreciate these deep dives into the hidden connections between geopolitical chaos and our financial realities, consider giving a thumbs up to support this channel. It only takes a second, and it truly helps us keep delivering more unbelievably intriguing stories. So, what happens next? Will we see a swift diplomatic resolution? Or are we just at the start of a confrontation that might rock the foundations of the world economy for months or even years to come? Let us rewind to the impetus for Iran's bold move. The United States strikes on Iranian nuclear targets. That in itself was a response to perceived escalations in the broader region, including the Iran-Israel conflict. The question is whether these military actions will intensify or if cooler heads might prevail. For its part, the Iranian parliament has gambled on the notion that the threat of blocking vital oil trade routes might force global powers to reassess their strategy. Tehran is well aware that the closure of the Strait of Hormuz will not score any points with countries like China or India, who rely heavily on that thoroughfare. Yet, Iran might see it as a necessary risk to protect its strategic objectives. The economics of conflict also come into play here. With oil threatening to rocket upward in price, countries that rely on cheap energy to keep industries humming are on edge. Think about major importers in East Asia. A sudden spike in oil costs complicates everything from shipping consumer goods to fueling factories, possibly prompting them to diversify their suppliers or accelerate renewable energy adoption. However, the world cannot flip a switch overnight. Renewables remain in a transitional phase, and while we have made progress with solar, wind, and nuclear, those sources are not yet ready to entirely replace the enormous daily oil consumption. This dynamic sets the stage for more price volatility and, ironically, an even larger appetite for speculative hedges like Bitcoin, provided it can regain investor confidence. That is precisely the riddle. Can the crypto market decouple from these geopolitical tremors? Or is it inevitably tied to the same emotional swings and risk-on, risk-off sentiment that moves traditional equities? Observers say it might hinge on how fast central banks respond. If inflation sets in, you might see rate hikes that rattle all markets, encouraging risk-averse behavior. Alternatively, if central banks attempt to cushion economies by loosening monetary policy, you could get a surge in investment into alternative assets, including crypto. So, ironically, while a crisis can drive people away from risk initially, it might later push them right back in if they expect monetary easing down the line. That is not the only conundrum. Our entire landscape of global finance has never faced a scenario quite like this. An emergent friction in one of the world's most vital shipping lanes, layered on top of a cryptocurrency realm that grew from a fringe phenomenon to a trillion-dollar ecosystem. If oil prices do surpass $100 a barrel, or if we watch them zoom up to 150, what does that do to the average consumer's trust in national currencies? And if trust in fiat wavers, will more people flock to decentralized digital assets? These hypotheticals underscore that we are living in an era where small decisions in one corner of the planet can unleash tsunamis of economic aftershocks worldwide. Zooming back to the Strait of Hormuz, let us not forget that it is not only about crude oil. This waterway also sees shipments of liquefied natural gas, refined petroleum products, and a host of other goods traveling through the Persian Gulf. That means the costs of shipping everything from plastics to chemicals could also spike. For resource-rich nations lying beyond the strait, shutting down traffic is akin to hitting the brakes on a major economic artery. But for Iran's leadership, it is presumably a demonstration of leverage, a proof that they too have cards to play in this swirling geopolitical chessboard. One wonders how the other global actors will respond. Will China lean on Iran to keep the strait open, reminding Tehran of the mutual economic interests they share? Or will Russia, facing its own share of international pressure, offer a helping hand or a strategic alliance to Iran, further shifting the balance of power in the Middle East? And how about the United States, which must weigh whether continued strikes or sanctions will provoke an even more dangerous escalation? In any scenario, the gambler's bluff seems real. If Iran persists, we might be on the precipice of the largest oil shock in decades. At this point, many are recalling previous oil crises and how they shaped the global economic narrative, from the oil embargo of the 1970s to the more recent disruptions in the 2000s. Back then, the world had no concept of a digital asset like Bitcoin. We did not have blockchains fueling decentralized finance or offering an alternative store of value. We do now, though, and that changes the game. Bitcoin's slump from $103,000 to $99,700, while significant, does not necessarily seal the fate of crypto. Historically, Bitcoin has displayed an ability to bounce back with surprising vigor once markets readjust their outlook. Another point to consider is that, amid wariness, some investors might prefer to sit on the sideline in stable currencies or even precious metals until the dust settles. That flight to safety is typical, yet it might also be short-lived once people realize that indefinite money printing or interest rate manipulations can degrade the value of traditional currencies over time. A possible scenario: as soon as it looks like the oil shock and supply crunch might stabilize, you could see a wave of capital streaming back into more volatile but potentially higher return assets like Bitcoin. This prospect raises the question: will we see a future where Bitcoin's greatest bull run is triggered by an extreme global event that undermines trust in paper money? If you are finding this conversation intriguing and want to be part of future explorations into these massive turning points, feel free to subscribe and join our growing community. You will not want to miss our coming deep dives. For people on the ground, let us not lose sight of the human dimension. In Iran itself, the average citizen might be enduring inflation arising from sanctions and possible isolation. In the United States, Europe, or Asia, everyday individuals may soon face ballooning fuel prices that ripple through everything from the cost of driving to the cost of delivering groceries. Meanwhile, companies large and small might cut back on spending, stall expansions, or even reduce workforce if the cost of doing business spirals beyond control. If the closure of the Strait of Hormuz extends longer than a few weeks, these conditions could accelerate, creating real hardship for many, and fueling political instability even in places that are far removed from the Middle East. Given all these uncertainties, the role of central banks becomes increasingly crucial. If oil surpasses $100 per barrel, we might witness inflationary pressures that prompt interest rates to climb. Higher interest rates can dampen consumer spending, slow down corporate investment, and lead to a downturn in equities, conditions that sometimes weigh heavily on riskier corners of the market, including crypto. On the flip side, if the global economy enters a tailspin, we might see a quick pivot from hawkish to dovish monetary policy, which can pump liquidity into the system. This policy whiplash fosters an environment of confusion that can see frantic sell-offs followed by euphoric rallies in rapid succession. It is equally worth exploring the broader Middle East vantage point. Neighboring countries have a stake in whether or not Iranian ships bar passage through the strait. They do business with Iran, or they rely on the waterway for their own exports. Some might be pressured or incentivized by global powers to take a stance or even join a coalition. Altogether, this is not just a simple one-to-one conflict between the United States and Iran. It is a tangled net of alliances, economic dependencies, and simmering ideological disputes. Such a scenario magnifies the unpredictability, especially when you throw nuclear capabilities into the mix. From a historical perspective, we have seen flashpoints in the Persian Gulf multiple times. Each time, the global community braces for the possibility that a localized event could ignite international crises. Yet, the presence of Bitcoin as a potential financial escape hatch is a new wild card. If you are an investor, large or small, the million-dollar question is whether to treat this moment as a chance to accumulate crypto at a discount, anticipating a flight from volatile fiat currencies, or to hold back, waiting to see if the strait actually gets closed and drags the entire global economy down with it. Meanwhile, commodity traders in cities from New York to Singapore watch oil futures like hawks, placing bets on which direction they believe events will unfold. The only certainty, in an era of immediate digital information and nuclear-level brinkmanship, is that the headlines will keep coming at us faster than we can blink. For technology buffs, there is an interesting side angle. If countries start exploring ways to bypass official shipping lanes or circumvent sanctions, we might see the rise of more covert and decentralized trading methods, possibly using crypto-based platforms. This might push the conversation on digital currencies from mere speculation into real-world utility, bridging global markets when traditional routes are blocked. Could we witness a world where national shipping lines or large corporations quietly adopt blockchain transactions to skirt the constraints of a closed strait? That speculation might sound like science fiction, but given the extraordinary developments of late, no scenario can be dismissed outright. What about the human response back in Tehran? Parliament's approval indicates a steadfast legislative stance, but implementation is no trivial matter. The resolution has to be ratified by the Supreme National Security Council, which controls Iran's big-picture security decisions. Ultimately, Supreme Leader Ayatollah Ali Khamenei wields the final say. If he endorses a complete closure, the region could plunge into a state of heightened risk, and the world economy might suffer. If his council decides to hold off or open the door for new negotiations, we might see a partial walkback that could calm markets. The next couple of weeks might be absolutely pivotal, as all sides gauge the seriousness of each other's threats. Within the crypto world, some analysts wonder if the segment that touts Bitcoin as digital gold can maintain that narrative in the face of real international strife. In the early years, cryptocurrency was removed from mainstream global events, existing primarily in niche tech circles. But as major corporations, financial institutions, and everyday investors jumped in, Bitcoin became intertwined with macroeconomic forces. The result? Even an oil supply crunch in the Middle East can make Bitcoin quiver. And that might be a sobering reminder for folks who believed crypto existed in a vacuum. It does not. It is now part of the same dizzying carousel that spins global stocks, commodities, and currencies. Industry watchers remain divided on whether this slump in Bitcoin is merely an overreaction that will soon correct. Some balance of power theories suggest that big players might actually be scooping up cheap crypto while retail sentiment is shaky. Others say the knee-jerk reaction reveals crypto's vulnerability to black swan events. Regardless of who proves right in the short term, the long game might still favor digital assets if inflation truly roars and confidence in fiat crumbles. Will that scenario unfold in the weeks ahead, or will diplomacy short-circuit the worst-case outcomes? That is the trillion-dollar puzzle one only time can solve. Among your peers, family, or co-workers, you might start hearing chatter. Should we panic about the next fill-up at the gas station? Should we hold on to our crypto or sell before the next big dip? The best we can do is analyze the data, stay informed about the evolving political and economic maneuvers, and weigh our risk tolerance. But one thing is certain. A closure of the Strait of Hormuz is not just a Middle Eastern issue. It is an event that touches the global nerve, from local groceries to international financial markets, from everyday commerce to the shimmering promise of digital money. In conclusion, keep your seatbelts fastened. This chain of events is a wrenching reminder that the pumps, the shipping lanes, and the markets all live in one interconnected ecosystem. A tension spike in one nook, like the Strait of Hormuz, can ripple across to cause an infinitude of chain reactions. From daily commutes to grand investments, from inflation rates to central bank strategies, and perhaps even to the fundamental reversal of power balances in the Middle East. Whether you are a Bitcoin fanatic, a casual observer of world affairs, or someone worried about next month's gasoline costs, the watchword is vigilance. If you found the twists and turns of this saga as gripping as we have, do not forget to share this story with those who need to hear it. Stay tuned. The next few days or weeks could completely rewrite the playbook on global trade and digital finance.